Good morning and welcome to the Post-Monetary Policy Committee press conference. The Monetary Policy Committee held its meeting on Monday, the 29th of May, 2023. And as is customary, we now have our press conference where the Governor of the Central Bank of Kenya will speak through the decision and also take questions from you. If you'd like to send questions, please do so through Slido. That's www.slido.com. The meeting identity is hashtag MPC 0523. So without further ado, I would like to welcome and introduce the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Good morning, colleagues. Good morning, everybody, wherever you are connected. And before delving on the business of this meeting, I wanted to first thank all of those that sent us messages of condolence, encouragement, support, and prayers following the passing away of our mother. It is a difficult time, but we are touched by the outpouring of empathy and prayers, and may she rest in eternal peace. So the MPC met on Monday to assess developments since its meeting in March. You will already have seen the press release, and this briefing will, as is customary, give you additional information and background considerations. And we begin with the global developments. Since our last meeting, the fault lines in the global economy have become clearer, but uncertainty and risks remain large. It is therefore more difficult to identify what you'd call a baseline scenario and distinguishing that from an alternative scenario, meaning what are the potential, let's say, paths that the global economy would be undertaking, and which one do you have most confidence on? So, in the first instance, inflation in advanced economies has continued to ease with declines in commodity prices and the impact of monetary policy in the advanced economies. And you can still see here that inflation remains high in those advanced economies. For instance, the UK is at 8.7, Euro area 7%, and the US has come down to 4.9%, etc. So inflation remains high in those economies, and I think we need to remind ourselves that their general target is 2%. So they are really ways away from where what you'd call their target really. This, of course, has led to questioning how much further and by how much will monetary policy have to tighten? So the timing of those policies, meaning how many more hikes in interest rates in those advanced economies, and how quickly. That is the discussion that has been there. Against that, there is, of course, the already weakened credibility of central banks. And that's why there's that sort of tension between the markets and the policymakers, central bank governors, our fellow colleagues, as they have been putting out their information after their MPC or their decisions, etc. Of course, underlying this, we've also had financial stability concerns in the advanced economies, which is something that obviously is has not settled. Those concerns remain high and will indeed have implications on the policy direction, or let's say the extent of policy maneuver, room for policy maneuver by the by the monetary authorities in advanced economies. Another element which is important is the developments in prices of crude oil, and the slide that we are about to show shows the developments of Murban oil, which is our own, let's say, our benchmark oil. And you can see from an average of about $100 last year, it's now at 76.3 $6.3 per barrel. But I think this matches the developments in the rest of the oil market, where in fact you have had a decline in prices, but what remains high is the volatility. And this is driven by the usual concerns. First and foremost is the market changes and positions by exporters, particularly the large exporters, and now particularly Russia, etc. And secondly, of course, the risks around global growth. As I mentioned before, there are a lot of risks around global growth, but and indeed the developments in the overall economy, in the overall global economy, and these obviously have tended to dominate the noise, let's say, in the oil market. Another point to mention, as we have done before, is the global commodity prices. And these have come down. And I think if you compare ourselves to where, let's say, we were in April 2022, and the slide there shows, for instance, palm oil. Palm oil has come down from 1,683, and now is at $1,005 per metric ton. Now it's true in the last 3 months or so there has been an increase from 940, or now it's at 1,005 as I mentioned. And the other prices, as you can see, have come down quite well: maize, wheat, fertilizers, etc. So basically, we are going back to where we were before in the context of what is happening in the global markets. And again, this is with the easing of international supply chain constraints that were so dominant last year. And here is a chart that we have been following or tracking, and this is the global freight transportation cost. So the cost of moving a 40-foot container. And this is really an index, so it catches everything, or it's built on an index and transformed into US dollars. And here it is, you can see the peak was at $10,840 per 40-foot container. And now it's a $1,584, which is actually in line or a bit lower than where it was, say, in 2019, at the beginning of that chart. Bottom line here is that those supply chain constraints have improved, and in effect now the prices are going back down to where they were before. So you may say the river is going back to its course. Then what about the global economic outlook? I think since we had a conversation last time, we have seen the WEU numbers, and this in effect is the April WEU. Remember when we met last was in March, and we said that we were expecting these numbers, and we didn't have sight of them. Anyway, here they are, and I'm sure you've already looked at them because they were released more than a month ago. And we had other discussions about this. But bottom line here is that the growth outlook does not look materially different from what we had before. That is the one that was, say, the January WEU update. And as you can see, the difference from the January WEU for global growth is just a decline of 0.1%. 0.1%. And that is global growth. Now, there has been others that I would want to flag, and obviously looking at global growth in itself, the number for 2023 is 2.8, sorry, is 2.8, which is, as you can see, quite low compared to recent numbers. But I think the point here is that it hasn't changed, as I said, materially since the last projection. There are some other numbers that we may need to point out. First and foremost is the US. The US number for 2023 is 1.6, and there is some significant uncertainties around this for reasons that we'll talk about in a minute. And of course, other Europe, the euro area at 0.8. This is lethargic growth. Let's face it. Even the global growth at 2.8 is lethargic growth. And of course, China, 5.2. 5.2 is, for China, is dismal growth. But I think we do understand why it's this. They are recovering from the COVID lockdown. They were the last major economy to open up after the COVID. They remained locked down for some time. And of course, other considerations, supply chain, etc. So, in effect, the real issue here is the potential for surprises. And we'll mention that in a minute when we consider, for instance, the risks around this global economic outlook. And I think I would want to flag two major risks. First is what I mentioned before, the continuation of, to continue to watch or to be concerned about the financial stability in the advanced economies. You do remember the issues that we discussed last time, the closure and indeed takeover of certain large U.S. banks, and potential risks on other aspects, or let's say other parts of the financial sector that are farther away from the main banking sector. Secondly, there was a whole conversation, more than a conversation, it's a significant, let's say, discussion about the debt ceiling. Debt ceiling, the debt ceiling in the U.S. Debt ceiling in the U.S. And I think this one now we see that there's progress. There's progress, and I think the point here is that if indeed we had not had this conversation, meaning an agreement, the risks were huge. And as was mentioned by the Secretary of Treasury in the U.S. Secretary of Treasury, this would have had enduring costs on not just the U.S. economy, but indeed on the entire global economy. So it would have been the equivalent of a nuclear explosion in the center of our financial system. And again, only a few people care how a world war is started, but everybody feels the cost of it. So in that sense, it was significant for everybody's sake, for the global economy, for our domestic economy, to have a resolution in that matter, which is the debt ceiling negotiations in the US. And we now move on to the second part of our conversation, which is on the domestic inflation, or domestic economy. And the first element here is on inflation. And the last numbers that we have is from April 2023. And you can see this was at 7.9%, from a peak of 9.6 back in October, and you can see the dominant drivers for this, or rather, let's begin with the main consideration here. First and foremost on food, that's the blue, and you can see it is coming down towards the end of the chart in April to 10.1. And fuel inflation is still elevated at 13.2%. And non-food, non-fuel, you can see, has stabilized and is marginally come down to 4.1%. The second slide is really one of contributions to overall inflation, right? So you can see in terms of contribution, food is dominant. And we'll talk about the breakout into food into vegetable and non-vegetable in a moment. And fear inflation, as you can see, is the second one, and that one, the contribution has come down to 2.8%. And non-food, non-fuel is at 1.3%. So I think the point here is that we can have a conversation, really, the drivers, as we said last time, was really on food. Next slide shows the contribution to food inflation, right? So you break this out into non-vegetables and vegetables. And you can see the vegetable element has come down to 1.4. And this is our regular vegetables, the sukuma wikis, etc., carrots, etc. And then, of course, the non-veg part still remains elevated at 8.7. And this, of course, well, I should have said this, on the vegetable side, the lowering of the prices relate to the improved supply with the arrival of the rains, right? Next slide presents the 4 key drivers: wheat, maize, milk, and edible oils. We had picked this up as contributing significantly to overall inflation. So 4 elements or 4 commodities. And again, you can see it's come down to 1.4% of inflation in terms of their contribution to the 7.9. 1.4 of that is these 4 commodities. And that has been coming down. So having said that, the question then is, with the good rains, we expect vegetable prices to come down, to continue to come down, and we'll talk about this in a minute. But I think the issue now is, we had already indicated that we would expect the inflation number of inflation to continue coming down. But when we went to the market, meaning ahead of this MPC, there's one element that stood out: sugar. And we found out from the agricultural sector survey that we conducted around the beginning and middle of this month, that the indication was that prices that gone up by, according to that survey, by 40%, 42.7%, in excess of 40%. Now, this is significant. And the discussion here, or should we say the reasons behind it, was the reduction in domestic sugar production, lower cane deliveries, and well, there's a whole conversation about why the lower cane deliveries, and part of that was that the farmers had already harvested their cane last time or last season because the prices were high then, and they wanted to benefit from that. So they have less of the mature cane, you know. This is the other one, of course, is that some farmers had switched to maize, again following high prices for maize. Then globally, there has been a significant reduction in production in various source countries: India, China, Thailand, EU, and there has been a slow harvest in Brazil. These are dominant players in this market. Now, on the other hand, the government has recently announced measures that would allow free imports on products, food products that include sugar. So this will generally moderate the high price increase that we seem to have detected, and we expect it to be validated in the yes, exactly, in the CPI, in the overall inflation that will be reported by KNBS today. We don't have sight of those numbers. We are just saying that from what we have seen in the agricultural survey, we see a major risk that is coming from sugar inflation. That said, of course, the monetary policy does not work on sugar prices or vegetable prices, and frankly, this relates to second round effects because, as you can imagine, sugar is used for many products. actually, as I understand it, including animal feed. So there is actually that sort of second round effect, just like fuel is used for many things, transportation, etc. So anyway, so we still feel that we feel comfortable that inflation will continue to come down in the next imminently really, towards our into our target and towards the midpoint of, or the midpoint of our target zone. So that's really what I wanted to say about inflation, and I think the next slide is on growth. We could move on to growth. And the first element here is on the real GDP numbers, or the GDP numbers that were released with the economic survey. Most of you have looked at these numbers carefully, so I'll just touch on them. And I think the first surprise, we were the most surprised because the overall growth that were for 2022, these are the first print numbers, was 4.8%. Ours, as you recall, was 5.6. That was the number that we had been holding for about, I think, more than 4 months. Because the last time we did not revise it, and we decided that we do need we needed some let's say the first numbers related to 2022. Now, the real driver of this was actually agriculture. Our growth estimate for agriculture in 2022 was actually minus 0.3%. And it turns out it was at minus 1.6%. That's a huge difference for such an important sector in terms of overall, the share in overall GDP. And so we have tried to understand better that difference, but in truth, we are still not at the point where we can say we do understand why our estimate was so out of line with the fast print numbers. That is some sort of steady work that needs to be done, so that work stream is continuing. But I think here is where we have already looked at our leading indicators and believe that we are quite comfortable with the accuracy or the robustness of those leading indicators, except for this one outcome, that is 2021. So it's a deviation we do need to understand better. For instance, but it's clear that agriculture was hit hard, right? Why? 2021 growth or rather a contraction of 0.4%, then 2022 contraction of 1.6%, 2 years in a row of contraction. You have to go back to 1991, actually 91, 92, 93, to have sort of sequential years that have, let's say, negative growth, or correctly, better English, contraction. So in that sense, it's very unusual to have it. And still on that point, it therefore means that there'll be a stronger rebound, if you are thinking of base effects and things like that in 2023. But I think the point here is that agriculture will depend, as always, on the rains that are there. And we have seen adequate rains. Even today we've been receiving the rains, and we are pretty much at the end of May. But I think the issue here is let's wait and see, and we'll give you a few more numbers on this. The next slide, maybe go back a bit. I wanted to just make the point that you can see that the growth was driven largely by services. Services sector grew by 7%. But also you can see there has been other numbers that are worth looking at. Manufacturing, 2.7, even though actually it has rebounded quite strongly in other areas. We'll flag those as we go. But I think it is a pretty, let's say, well-distributed sort of growth in terms of the sectors. So the sectors are picking up. There are a few surprises, but I think the real surprise is agriculture. So moving on, this is a slide we show you every now and then, this time around we decided to show you, which is to show you the blue relates to our leading indicators index, right? So of economic activity. And the gold is the outcome. So you can see how the blue is tracking the gold. Obviously we know the blue more, right? I mean, that's what we know. And that's what we use, that's what we are projecting. So we can move it, we can project right to the end of, let's say, 2023. And for Q1, we are projecting, given these leading indicators, we are projecting a growth of 5.1%. So this means that there's continued dynamism in the economy and a strong strengthening of the economy is underway. Next slide now gives us a few more details, and I'll go through the sectors quite quickly. So here, maybe beginning with the two items on horticulture. We keep talking about horticulture for many reasons, because it's also related to exports, right? But here, yes, it is on the export side. And I think the decline in lower growth, as it were, April was 8.2. But we do expect that this will strengthen. We've talked about some of the horticultural exports, flowers, avocados, fruits, etc. And we expect this will actually strengthen a lot more. On the right-hand side, these are some numbers that in terms of the projections of production. The maize number there you can see is quite strong at 44 million bags. Yeah? And basically, what is clear is that yields have increased, or farmers tell us, as we will see in the agricultural survey, that they've increased acreage on farming acreage, and expect on the whole, and expect the yields to also be higher, largely because of the rains, and secondly, a lot of them have already received the subsidized fertilizer. Maybe some of them didn't receive it on time, but both those two elements lead to a sort of expectation of higher overall output. This is a sales turnover. Some of you are very familiar with this, and I think also maybe the April number is a bit of a surprise to us, but again, maybe April is affected by various things, as you know, maybe also part of our political issues that we had. And in manufacturing as well, a decline of 3%, and again, from a very strong outcome in January, February, and March. Manufacturing activity in terms of consumption, again, is tracking a decline, tracking the numbers I just mentioned before, a moment ago, the decline. But here is lower numbers, again, not a surprise, but I think we expect a significant rebound on these numbers. Cement consumption, this I think we've talked about a lot, so I'll just pass on it and talk maybe just very briefly about accommodation and food services. And I think this one, we also have good numbers, as we'll mention in a moment, about the forward bookings in accommodation and again services. A lot of the services sector, or rather a lot of I was going to say that the hotels, the evolution of the hotel sector, the strengthening of the hotel sector, also is connected in some sense to the food services sector, even though, as we know, there are a lot of food services, outlets that are not connected to the hotels, right? But I'm just saying that in terms of demand, etc. They are very much, they track each other. I think this is the last slide I want to show here. There are many other slides we could show, but in the interest of time, we'll move quickly. And you can see credit growth. This is the 12-month credit growth is at 13.2%. And this, in some sense, is reflective of the overall economy. That is, credit is beginning to get into the various sectors. We have a decomposition of this and here is manufacturing growing by 21%, trade 13%, transport 18%, consumer durables 13%. These are large numbers. We don't expect this to be excessively large because the question there is, are credit standards lowered? And the answer is no. Actually, from the other side, meaning having survey, from the survey that we put out on the credit officers, they have maintained the credit standards that they have been having, that is tight credit standards. Fine, so that was the last element there. The next slide relates to, I'll give you a couple of, let's say, slides that maybe teasers on the surveys that we have received so far. And this one element is on the business optimism. So on the top left is CEO survey, and you can see there has been modest improvement in optimism by private sector firms as they report the CEO survey, market perception survey, and indeed also for both banks and non-banks. So there they are. You can see the difference between March and May, right? March and May. So modest increase. What is this attributed to? Obviously better weather conditions, which are expected to support agriculture, to strengthen agriculture, easing of inflation, and indeed the resilience that we have always seen and talked about of the private sector. There are concerns which the respondents have raised, and I would urge you to look at the detailed documents that we are going to be releasing shortly. So these are the concerns relate to the proposed increase in taxation. This is what the respondents told us. The rise in electricity and fuel prices, and the weakening of the Kenya shilling. These were the principal concerns that respondents presented to us. The next slide is again from the agricultural survey. This is the one I mentioned earlier. So we asked the respondents, we asked them in the survey to tell us about what they expect to see in retail prices. Remember, these are people that are in the agricultural sector, and so like the farmers and people that are involved, the middlemen, etc., that are involved in that market. And not surprisingly, the greens, that is the declines, you can see a lot of those are vegetables. And I think this is fully understood. There are some that are a bit of a surprise, but I think on the whole, it aligns with our expectation that the vegetable prices will come down, and therefore vegetable inflation will come down appropriately. On the right-hand side, there are some things that have gone up, or at least they expect will go up. And I think the one that is significant there is sugar, which, as I said, was at north of 40%, and cooking oil, cooking fat rather, and cooking oil. And those elements, obviously, they are part of CPI. But I think the dominant one, as we mentioned, is sugar. I encourage you to look at the detailed documents which will be released shortly. The next slide talks more, and this is the last slide I think in this from the market perception from these surveys, is really to show you the hotel bookings which remain strong. So more, let's say the panel on the right-hand side, and that is showing that an average bookings rate of 52 in May, and all the way to 35% in July. So we are in May, and this survey was early in the month, so the first 2 weeks of the month, and already you are seeing about more than a third of forward booking, which, as we know, is quite strong. And they are supported by both foreign and domestic markets, which again is also something that we appreciate. And we know that as we get closer to the, let's say, peak season, these numbers will rise dramatically, towards 100%. We all understand what happens in July and August, particularly when we have the migration, etc., the migration of the wildebeest. And so all those sort of cycles will kick in, and from a base that we have, that we feel that is reasonably strong. I think that's all I wanted to say, and the next one is moving on to the balance of payments. And on the balance of payments, I think the exports have continued to grow. They remain strong at overall growth of 6.6% in the 12 months to April. And they are driven, for instance, by tea and manufacturers. So looking at, you can see tea there, but now double clicking, as it were, on the tea. And you can see the volumes of exports by destination. Pakistan, Egypt, obviously dominant. And also the values, right? The one thing to say is also to assure you that the concerns that were there a few months ago, actually 2 months ago, with regard to, let's say, difficulties for our destinations, and in particular Pakistan and Egypt, to make payments. Those have now been dealt with, and shouldn't be a concern, and there are mechanisms that are in place. For instance, in Pakistan, they actually designated tea as a sort of an essential commodity. It had been excluded and now it is in there, and therefore they are getting the foreign currency as needed. And also the other mechanisms that were put in place, meaning other banks have come in to provide, let's say, a platform through them for making the appropriate payments and transactions to those countries. Then moving on, the next slide is, so we'll move on this one, but it will be in the package. On imports overall growth has been 1.2% for the 12 months, and this is driven by largely a decline in machinery and transport goods, and this is driven by the closing of infrastructure projects, etc. But I think the point is you can see that oil continues to sort of increase that, to push up on the import bill, 5.6 billion compared to 3.9 billion in the 12 months to April 2022. There are other points that one could make on this, but and I think the first one is on the, if you disaggregated imports in this way and excluded in the intermediate imports oil, you can see the intermediate imports excluding oil have declined. That's 9.5 from 9.9, right? And capital goods have also declined. Consumer goods have remained, pretty much flat. But I think it's good to see that it's good to track this sort of composition, right? Intermediate excluding oil and also capital goods. Services exports, I don't want to say too much about it, but I think travel receipts, you can see the movement there, and I think the best one is the purple. You can see the purple now has shot up above everything, above the forest, the green forest and the blue forest and the yellow forest. I don't want to spend too much time on this, but I think on the numbers, 2023 numbers, the blue show that, as we had said last time, we are coming back to where where we were before the COVID, before COVID hit us. So we are again now approaching pre-COVID levels, which is obviously something that we appreciate. Diaspora remittances, this we had seen before, and we had talked about it. This is to April, 12 months to April. And the point here is that there has been a slowdown in some of the remittances coming in, particularly because the diaspora, the Kenyan diaspora that are sending money back home, they have their own concerns about inflation, etc., cost of living. But on the other hand, unemployment, particularly in the US, has come down to historic levels, and therefore we do expect that our diaspora will sort of get better paying jobs, if not only better paying jobs, but maybe their salaries. This will impact on their wage bill, as it were, and therefore they'll have more capacity to provide their payments to their family, etc. So putting it all together, we have the current account at 5.2, a deficit of current account deficit of 5.2% of GDP. And against this and against the projections that we have made, we expect that this will remain around 4.8% at 2023, so modest decline. Again, we've made the point that the 5% level is really a sweet spot, the current account remaining around 5% of GDP, and that would generally be closed using, by capital flows, both private and also public. Moving on, we can talk about the foreign exchange reserves. This was as of May 26, where it was up to 6.5 billion, about 3.6 months of import cover. That's what we reported. But I think the point is that we have also mentioned to you what we expect in terms of inflows. On top of this, we expect $1 billion to come in from the World Bank. This related to the recently approved DPO, development policy operation that the World Bank is financing, and that is imminent, meaning everything, now it's just sending information back and forth between the treasurers and the treasurers here and there, and this money should be with us imminently. We also expect some other funding, which we had talked about. There's of course we are expecting about 100 million from the AFDB, that's the African Development Bank, 100 million US. And we have already received some proceeds from a syndicated loans. That's a total of about 500 million. And we expect in July to have, we expect the IMF will conclude its review. That is a board discussion maybe by mid-July. And upon completion of that, they were here, as you know, and they completed, we got into sort of staff agreements on this. So they concluded their mission, and so now they are in Washington. They are preparing the documents that relate to this, and will present them to the board. And obviously we expect that the board will approve what is presented to them, which will lead to disbursements and also other aspects. As an aside, I would say that there was a proposal for increasing the amounts that they will be disbursing over the next few disbursements. But there was also another arrangement which related to the so-called Resilience and Sustainability Trust, or Resilience and Stability Facility, which is a new facility that is connected to climate. So all our work on climate change, and as you know, Kenya is a leader in climate change, meaning both in terms of policy but also in terms of action. So they will be supporting some of our actions. And on the basis of completing those actions, then disbursements will be made. So this we expect will be on top of the twice augmented arrangements that we have been having, and now just expect the board will conclude the fifth review. So I hope I've clarified some of the concerns that some of you have had in this area. Finally then, maybe a couple of issues on the banking sector. And I think the banking sector has, as we have said before, remains stable and resilient in terms of the broad indicators in this sector, and so sufficient capital, liquidity buffers, etc. And what are the concerns? I think first and foremost is credit risk, and as one would expect, when credit risk at times, those risks crystallize. The ratio of NPLs to gross loans, it increased to 14.6% at end April from 14% at the end of February, so increased by that much. Now this is attributed to increases in the specific sectors are manufacturing, real estate, building and construction, and trade sectors. A lot of this really relate to the challenging business environment that they are in, and the delayed payments from the public and private sector. So these delayed payments are causing a huge drag on the economy. And I think the issue here is, you may say that there is collateral damage, but this collateral damage will come back to in a sense, weaken further the economy. So this is why it's so important to actually create a sort of a positive dynamics, right? So you have a virtuous cycle beginning with the payments of those, let's say, delayed payments, etc. Now, the government has a lot more, or will have a lot more liquidity in having had the disbursements that we talked about, external disbursements, and therefore can use them as to clear at least some of the payments that they have on in their inbox, as it were. I think the other one that is important to mention is obviously the operational risks. Those remain high, and in a sense, or remain elevated. Yes, and this is really not a surprise, considering let's say how we are doing business. And one of the things that for us, we are doing a lot of digitized services, right? We are digitizing a lot of our services. So concerns about cybersecurity, fraud, etc. remain elevated, and that has to be dealt with. Then I mentioned the issue of the global banking sector developments, which again, if this actually crystallized, those risks crystallized, they would affect not just those economies, but everyone else across the board. Just for you to know, we have the last thing in terms of data. You know, we put forward this sort of risk-based credit pricing model, you know, asking banks to present theirs. And we have reviewed all models that were submitted to us, and we've engaged with commercial banks, those commercial banks individually, on their models, on their pricing models. And so far, we've concluded this sort of discussions with 33 of the 39 banks. And they have proceeded to rolling out their risk-based credit pricing models, and of course we'll be reporting their implementation. Another point just for you, the digital credit providers will continue to strengthen this sector, and following the regulations that were approved by the National Assembly in May 2022, and we have licensed a whole set of them. It's on our website. We've licensed 32 digital credit providers, and at that time, actually, we thought we had about 200 of these digital credit providers. Surprise of surprises, the applications have shot up to 400. So we are working to see how this will be, to process them. We are processing them as we should, according to the standards or the law that applies at this moment. But the concern, of course, is that despite the law coming into effect, some digital credit providers have not been, let's say, licensed. They were operating, and therefore they were allowed to continue operating while they were seeking, let's say, approval or licensing from the Central Bank of Kenya. But some of them have not completed this process, and in effect, some of the noise is from them. So we will continue to push and move quickly in terms of licensing of these DCPs. I had already mentioned the credit-related risk management in the context of the RST, meaning talking about credit risk, but I think there's a lot of material here that any of you can look at. Finally, just to complete the picture, we've been moving on. Well, we've published the Bank Supervision Annual Report back in May 15, and there's a lot of material in there. I now realize that I skipped, in effect missed, an important element, which is discussion, or to mention, to give you feedback about the Forex market. I'm sorry for that. And I think the point here is that, yes, we did witness pressures in last year in the FX market, and in March we began to reactivate the interbank market. Basically, just to give you a picture of it that would endure, in a sense, what was happening is you had, if you think of a distribution of trades in the market, you had the distribution, and what happened is that you squashed down the distribution, and therefore, there was the tails became fatter. So, and the trades, therefore, that were happening in the market, you'd expect that they would be around the interbank rate. But the point is that there were a lot more, because now the distribution is fatter. They were farther away from this interbank market. And so, in effect, if you want to put it that way, the idea is to squash back the distribution and have the midpoint, or let's say I don't want to call it the average, right? be the interbank market, what is happening in the interbank market. And that was really the essence of it. So reactivating the interbank market. So in effect, the prices that apply are those that relate, they're teeing off the prices in the interbank market. Of course, it wasn't just reactivating the market. It's not like you flip a switch and then you reactivate it. It was a lot of work with the banks themselves, and including the issuance of this code that we talked about, the FX code, to strengthen and provide long-term sustainability of the FX market. And of course, we worked with the market to re-anchor the market to the interbank and provide this sort of more enduring, sustainable pricing framework. We are happy to say that this has been working, and the distribution is coming closer and closer around the interbank, and more transactions are taking place in the interbank. And so banks are less concerned about, let's say, having a lot of their resources, quote unquote, being provided or targeted to their own clients, because they know they can always go to the interbank when they need it. So if the interbank is there, everybody is okay. And that's really where we are heading to. Of course, there's all those concerns about the oil market, and the oil market is dominant, as you know. Back in maybe August, September, October, the numbers were somewhere in the order of 500 million per month, US dollars. And that has, with a decline in prices, that has come down to about 250, and that is before the kicking in of the G2G. So numbers have come down to around that level. So in some sense, it was beneficial to us, the declines in the international oil prices. They were beneficial to us. Secondly, also, there had been some swaps that the commercial banks had with some of the oil marketers, and those are also being worked down, meaning being wound down, rather. So in a sense, we are expecting that this will continue, not just continuing to hold, but continue to strengthen, and thereby, using an expression I mentioned before, the river returning back to its course. So I hope I've covered those things, and maybe the one other thing I would want to mention is the CSD. Yes, I mentioned some time ago that we would have this, that we are putting together the Central Security Depository. And I did mention that this would be revolutionary. It will be, in effect, sort of the gold standard in CSDs in the world. And I want to repeat that again. It will be the gold standard in the CSDs around the world. Now, it's true, I had mentioned before that it will be released in March, but as happened, there were some, let's say, technical issues that they had been working in, which took longer. And so we expect this to be resolved, and they're making good progress in it, to be resolved imminently. What I don't want to do is to put out a date and say it is when, next month or any of these things, but I think that will be announced as soon as we have, let's say, clarity or sight of the end point, the finish line. I think the finish line is within reach, but we do need to have sort of clarity, 100% assurance that we are getting to that finish line, and we'll announce it to all of you. I'll stop there and take your questions. I notice that I've spoken for too long, and I'm sorry for that.
Thank you very much. That was the Governor of the Central Bank, Dr. Patrick Njoroge. Straight into the questions, we begin with Eric Mukaya. Eric is from Wango Capital, and Eric's question is, what informed the pause in rate hikes given the massive increase of 75 basis points in March? Kefa Moirori from the Business Daily, a couple of questions from him. On the last day of the credit repair framework, would you kindly offer us an update into the uptake of the scheme by borrowers? And there's a related question on that by Julian Zamboko, who had also asked whether we could get an update on the credit repair framework, as today is a sunset date. Kefa's second question is on the foreign exchange. Do you feel the issuance of a local dollar-denominated bond would help to lift the local currency? And he continues, what other options would you feel would be useful too?
Okay, thank you very much. So, in terms of the questions, the pause in rate hikes I think I've explained myself why is it that the MPC thought that the best judgment in the circumstances was to allow was to maintain, let's say, the tightening stance that they had put in place cumulatively through March, right? But I think the one thing I did not mention was that, and importantly, the measures that were put in place before are still working through the economy. It takes a bit of time. Monetary policy, there's a lag to it. Yeah? It can be anywhere between 6 weeks before the first effects begin to kick in to 7 months, 9 months, etc. So in effect, looking at the pace of, or should we say the impact that was still filtering through, impact from the previous decisions, and also the state of the economy, and in particular, inflation outlook. I've explained myself what were the principal drivers of inflation, and inflation was coming down, and the real, let's say, spanner in the works was sugar, and I've explained why sugar doesn't have, you cannot control sugar prices with monetary policy, right? So only the second round effect. So we need to have clarity about that. At the same time, we have food prices coming down quite sharply. So in a sense, it was better to, given all this data, the MPC decided to hold. I think I would rather, on the credit repair framework, Kefa, I think the best thing here is to wait until we resolve everything. Yeah, it is, let's give you the final information appropriately. So I don't have any information to give you today. I do understand the timing that you're mentioning, but maybe at the next MPC, this question can be taken up. And then on the Kefa's question about local dollar denominated bond, I guess to help lift the domestic currency, I guess this means on the exchange rate side. I don't know. I think there's a lot of considerations that need to be put in place, and it isn't sort of a slam dunk. Sorry to use that expression. It's not a sort of a surefire thing. There are many issues that one needs to consider, and I think the point here is that maybe the one thing to mention is when this is raised, it's generally raised in the context of there's a lot of deposit, people are holding a lot of dollars, etc. And I don't think that actually this is fully well understood. So maybe, do you have a slide that I can, from one of my slides? I have a slide that is, I don't show it because it's ours, but this one I thought maybe I show you. So just to be clear, what is this? This is the issue that some of you have written about the $1 trillion deposits in foreign currency, right? That's what you're writing about. Let's begin by saying that if 1 trillion, if you look at that as a share of total deposits in the economy, it's about 20%, right? Fine, and stable, etc. No real concern from the share perspective. But when you see it, so this is FX deposit in US dollars. That's the blue lines, right? And the only change there that is, the only it's a general growth, but there's one point where it is a bit odd, which is in 2019. From 2019 to call it 2022, yeah? So there's a bit of an acceleration in that space. And again, looking at data in detail, so you have to, well, okay. So what caused this? Beyond that, it is much more gentle. You are back again in a trend line sort of growth. And really what this happened is two elements, which is the foreign, operations of our local banks in foreign subsidiaries, that is in the foreign other countries, in the region. I will not try and explain how that works, but I think let's just say that is what, or not just say, that is one of the principal drivers of this number. The other one, of course, was banks. Some of the banks were financing, early in this period, were financing some of their lending externally. So getting a loan, etc., from a foreign lender, which then they use to on-lend to local entities, etc. So involvement in that. So I think if you sort of understand that and then look at the trend after that, the trend is along the trend line. So there's nothing, and if you do it in growth rates, etc., there's nothing really of concern in that space. Now the question that we can do it also in a different way, which is looking at it in Kenya shillings equivalent, and that's the gold line. Yeah, that is the gold line. Now it looks like it's growing sharply, but actually the point is that if you have let's say $100, and you're calculating each year, so you're holding the $100 constant, and you're calculating each year how much is that in Kenya shillings. Of course, you'll need to include the exchange rate movement. So you'll need to purge, let's say, the exchange rate from this, and once you do that, it's much flatter. So the concerns, in a sense, of this being the foreign currency deposits, in my view, or in our view as a central bank, are misplaced. There's no free foreign currency that is sitting somewhere in somebody's account. And furthermore, the use of the banks are already using this foreign exchange. That is the same way. If you have Kenya shillings and you have a deposit in Kenya shillings, the banks are using them. So there isn't any sort of idle cash that can be used for other purposes. But let's go back now to Kefa's point. So what would a dollar-denominated bond do? Actually, in this space, it wouldn't get any more. It wouldn't, in a sense, mop up those excess dollars, because there are no excess dollars in that sense. Yeah? It is only beneficial to the extent that it attracts new dollars from the rest of the world. And we do this in two ways. We do it in first, when we issue a Eurobond, yeah? A Eurobond actually brings in new foreign currency into the system. And for the most part, when you float a Eurobond, it is bought by external investors. I'm talking of foreigners, residents elsewhere. It is true, some of our institutions do also buy those Eurobonds, but I think the point here is significantly it is by non-resident investors that invest in our US dollar denominated Eurobond, and therefore the money comes in as new US dollars to us. Yeah? So that is one thing that I think is important to note. Secondly, in terms of Kenyan investors, you have what? In the sovereign, let's say, in the sovereign assets or sovereign exposure, if you want to put it that way, you have 55% of these are banks, or banks are holding 55% of it, pension funds 35%, and then the rest of it is the rest of us, right? The retailers, etc. When you invest in treasury bills, etc. So the point here is that it is very hard to think of, the 100 shillings or the 1,000 shillings that maybe the retailers will have, that is you and me, yeah? And using this very difficult, let's say, dollar-denominated bond to mop up those small, as we'd say in Kenya, small deposits, or let's say US dollar amounts that are out there. But maybe the last 2 points on this are, first, to be clear that it is never, the short-term problem needs to be looked at also in the long term. And there are many institutions, recent institutions, or should we say sovereigns, that ended up tripping themselves precisely in this way. We can hold that conversation separately, but I think the point here is that it's not a sort of a win-win situation. One needs to look at what happens later on. And basically, you need to go back to what we consider as the fundamentals, resolving the fundamentals. And that's what we've been doing in the foreign currency market. We need to give it time so that it can strengthen. There's no sort of, let's say, slam dunk solution to anything. No, I mean, try and run the marathon, and you'll see you need to train for a lot longer. You don't begin anything that is beneficial takes time, and you have to build it from the ground up. Finally, just remember that this would end up also fanning the flames of dollarization in the economy. And look at all those economies that ended up having this sort of significantly. So dollars end up becoming the dominant currency, and everything is priced to the dollars, and etc. And then you have dollars. It's a slippery slope. And I think in terms of the benefits, I'm questioning the benefits. But I think the best way to deal with this is to continue talking about it, yeah, and then seeing in detail what are the pros and cons. I think, Kefa, you had more than you expected, so I'll leave it there.
Thank you. Another batch of questions. We begin with Frank from Banto Limited. It's about crypto, and he says, you have had good words regarding crypto and decentralized finance. I'm convinced it's our only saving grace at this point. Are you passing the same knowledge on to your successor? Similar question from Milan Leshan, who's from Crypto Hub KE. You've had a tough and clear stance on Bitcoin and use of crypto. With the new tax proposals on the Finance Bill 2023 and in the Crypto Regulation Bill, does your stand change? Don Mogambi from SEP Transporters saying, citing Basel III, the Central Bank of Kenya reviewed capital adequacy risk weighting from 50 to 35% for residential mortgages. What has been the net result of this policy?
Fine. So maybe beginning with the crypto questions. I think the first thing to understand here, I think, is the central bank has been here for, 57 years? And it will be here for another 57 years, and so forth. Yeah, so it is a going concern. So it's a going concern both in terms of policy and in terms of operations, etc. So there isn't any sort of personal stake in terms of understanding, etc. The wealth of information is in the central bank. It is there, and we have to appreciate it that way. Now, it is true, everybody has their own taste in this or the other, personally and otherwise, but those are not what drives the institution. So yes, in terms of passing on knowledge to my eventual successor, I think the answer is the central bank is there. And it is really through the central bank, through a well-functioning central bank, that happens as well. Of course, for my part, in my handover, we'll cover whatever needs to be covered. But I think the point here is it is the central bank, and it is not personalized to anybody. Secondly, on the issues of tax, I think we have to distinguish all this, the crypto, let's say crypto transactions, etc., and other other transactions that you can say are caught up in the tax bill, etc. I think it is important, particularly when you think of exchanges, right? If there's any exchange, any transaction, it's clear whether that is caught or is not caught, right? That is one set of issues. And the other one is whether or not those things are regulated in a particular way. And I think we've been making the point that unregulated transactions such as this, and I don't want to single out crypto because that's a big, that's just one element of a bigger, let's say, spectrum. Yeah, regulation is important, and that is the only way to assure us that those transactions are safe, they don't introduce new risks, and we've made the point that at this moment they provide significant risk to our economies. And I think we are not the only ones. Most of the other regulators around the world have taken that same position. And therefore, if it is well regulated, things are easier. But I think the point is, you just saw what happened to the DCP. And we're still fighting those issues, as I mentioned before. So you can imagine how things will be. This is, DCP would be kids' play compared to, let's say, the destruction that indeed also about our reputation. I'm talking now reputation of the jurisdiction if indeed this happens. So my point is we continue to, the central bank continues to push on those points, and I think that is why we, and with the other regulators as well, with the National Treasury, and any other policy maker who is in this space. Now on Basel III, I cannot tell you anymore. I cannot tell you because I don't have any information about, at this moment I didn't bring it with me. So I'm sorry, Don, this is, I didn't bring information that would help me answer that question. What else?
All right, so we are looking at the final batch of questions. We begin with Martin Muita from The Star, who asks, what is your take on de-dollarization, especially in intra-African trade? Will it have any significant impact on foreign exchange reserves? Then the next three batch of questions are similar. From Brian Gugi of the Standard newspaper, my condolences on the loss of your dear mother, Brian says. Do you have any highs or regrets about your 8-year tenure? Eric Mokaya from Mwango Capital again wants you to reflect on your tenure, and especially what are your points of success and failure? Have you accomplished all that you set out to do? And do you have any advice for the incoming governor? Davis Ombanev, a student from the University of Nairobi, you have been a passionate champion of youth startups and overall empowerment. Should we expect any more of these from you after your exit? And also asking for your reflections on working with the East African Community Central Bank governors and the Central Bank of Kenya staff.
Okay, thank you. A lot of questions there. I think the first question by Martin, de-dollarization. I think this is, at a high level, is a plus, right? So you're talking of reducing the dominance of dollar trade. That is the trade that takes place naturally, and underlying it, dollar sort of flows, pricing it in dollars and value moving from the buyer to the seller, and that transaction is conducted in dollars, etc. I think, as I say, at the high level, it is a plus, but the devil is in the details. So, and the pace of this. I would mention that this is a conversation that has been taking place in our circles, that is of governors, etc., for some years now. And actually, every 5 to 10 years, there is a significant sort of push to de-dollarize in this sense, right? I use the de-dollarize in that sense, in quotation marks, because it also means other things. particularly to us economists. Okay. So in this context, it is for trade. Of course, in Africa, we need to do more of that, yeah, to trade in our own currencies, etc. But the issue at the end of the day is to make sure that the value transfers. And so, for instance, in the East African community, surprise of surprise, we trade in our own currencies. Yeah, so you can actually buy stuff from Tanzania in Kenya shillings, or you can buy it in and then make a payment in Kenya shillings, or you can buy it in Tanzania shillings and make your payment in Kenya shillings, etc. So I think the point here is that the East African community is a little microcosm of what all of Africa is. Now, what has been happening here is that actually the East African community sort of platform that we have, we call it EAPS, East African Payments something system. Yeah, there's a P there that I don't remember what it is. But the point I would make here is that this is really what we intend to do for the rest of Africa. At the end of the day, there is an issue of what happens if you're on one side of the trade. So for instance, if you're always buying things, if you're always, let's say, selling things to a particular country, so one-way trade to them. So what happens at the end of the day, at the end of the month? Yeah. So value then needs to move from that country to ourselves, and how do they do that? Yeah. And I think those sort of considerations are the ones that the devil is in the details. Those are the details that need to be worked out. But in terms of moving ahead, this is obviously appreciated and is something that we should think of and expanding it from the East African community going forward, or maybe putting in a sort of a stronger system that mirrors or mimics what goes on in our East African community platform. Impact on FX reserves at the beginning, nothing. Yeah, this will only be gradual as the trades sort of build up, etc. But I think it is important to see it as something that there is long-term gain. So when you build a bridge, the immediate impact may actually be a negative one. Yeah, but I think in the long term, there is actually a lot of potential, and it has to be taken at pace. Then questions about, I would say I think this both questions are by Brian and Eric about my tenure and all that. I think those things, they do have they have a place, but I don't think it's today. I still have a few more days to go. So I would rather reflect on them, at the right time, in the right place. So, and I think all those questions can then be dealt with there, including all these other questions on this. In terms of what my successor does, or what will happen, etc. I think all that is open. And again, as I say, the central bank is a going concern, and it's hardly you can hardly anchor it to one person, etc. So what I do in the future, again, all those are questions that we can deal with at a later point. And Brian, thank you very much for your condolences. As I said in the beginning, we do appreciate the support that we have received from you, all of you, and your messages of sympathy, etc. Thank you very much.
Thank you, and that brings us to the end of this press briefing. This was a press briefing subsequent to the Monetary Policy Committee meeting on Monday, the 29th of May. And as is usual, we shall have another MPC meeting in 2 months and a press conference after that. But as it says in the press statement, if there's any need to meet before that, we shall obviously let you know and let you know what the outcomes of that. But with that, we'd like to wish you a good afternoon. Thank you very much, and do have yourselves a good Madaraka Day.